To save for your retirement, you're going to have your money in the employer-sponsored 401k plan and or a Roth IRA. And within those investment programs, you're going to put your money into mutual funds and ETFs because they provide diversification and low fees. But then I told you that within mutual funds and ETFs, there's lots of different investments that you can choose from. So what do you want to invest in? That's where we're heading now. So take a look at this chart. And this is kind of busy, so we'll spend a little time looking at it. Treasury bills. So these are government bonds that you can buy. And this shows what they've done over history. So we have, what, 80 years of history here. And what you can see is that Treasury bills have gone up in value, but fairly slowly and not a great return. The next is government bonds. These are going to be shorter in term, so you've got a little more return on those. Then you have this light blue line is large company stocks, and the dark blue line is small company stocks. So what conclusions do you take from this chart? Well, stocks go up the most, right? They've got by far a greater return over time than bonds have. But there's another important point I want you to pick up from here. Notice that this Treasury bill line, which doesn't go up as much, it's a pretty smooth line. The government bond line goes up a bit more, and it's fairly smooth. It's got some bumps in it, but it's fairly smooth. The stocks go up the most over time, but there are also bigger and more frequent swings in the return. And small company stocks, which provide the greatest return, also have the greatest number and size of the bumps in the road. Oh yeah, I should also point out large stocks over this time period have averaged a 9.6% return, and small stocks an 11.7% return. So in the investment scenarios that I've shown you, the retirement savings scenarios, I've used rates of 8%, 8.5%, 9%. This shows you that those are very achievable returns. Those are not unrealistic numbers. Again, the main point I want you to take from this is that stocks provide the greatest return over the long term by far, but they're also bumpier. They have good years and they have bad years. They even have good decades and bad decades, but over the long haul, they're superior. So investments are broken down into two broad categories. Stocks, where you are buying a piece of a for-profit company. Stocks provide higher risk over time, and risk means volatility, the opportunity that the price is going to jump up and jump down, the chance that you might lose your money or some of your money. But over the long term, they provide a higher average return. Bonds are a form of debt where the government is borrowing money from you. You give money, you buy a bond, you're giving money to the government to use, and in return, they're paying you a set rate of interest. There are also corporate bonds where Amazon might sell a bond, in which case they're borrowing money from you. You buy the bond, they take your money and use it, and in the meantime, they guarantee to pay you a set rate of interest. Those are bonds. They are lower risk. The price of the bond, the value of the bond, does not vary as significantly. It does vary some, but that's too complex for this class. But you're also getting a lower return every year than you would with stocks. Bonds, governments and companies sell bonds to borrow money for a set period at a set rate of interest. A bond might be for 5 years, 10 years, 30 years. Right now in Europe, they're even offering some 100-year bonds, which I've never seen before. When you buy a bond, you lend them the money, they pay you interest and return your money when the bond matures. So to recap, you buy a $1,000 bond for 10 years. For 10 years, they have your $1,000. They pay you interest every year, say 5%. And then when the 10 years is up, the bond matures, they give you your $1,000 back. Stocks, you purchase a share of a company, and you earn a return from stocks two ways. One, companies pay dividends. They take a share of their profits and send it out to the shareholders. This is generally a smaller part of your return on stocks. The primary way you make money from stocks is capital gains, which means you buy a stock at $20. Over time, as the company grows, the stock becomes worth $40. So you've gained that $20 in value because the company has grown, become more profitable, so the stock is worth more. Stocks are riskier. The profitability of companies fluctuates. We have the economy goes up and down. This obviously COVID has provided a great example of this. The economy was humming last year, and then COVID hit and we shut down businesses. The economy went into the tank. The unemployment rate went from extremely low to extremely high. People quit spending money. So the economy just turned on a dime. And individual companies within that, some were hurt drastically, right? Like airline companies have been crushed by the change in travel. Other companies have flourished. Amazon, how many of you have not increased your Amazon shopping since last March? I most definitely have. Also within companies, they make good decisions and bad decisions. Management says, we want to do this, we want to do that. Sometimes they're right, sometimes they're wrong. If they're wrong, that causes the stock to drop. You have changing markets. In recent years, you have seen retail stores. You know, the stores that you see at malls have been dying, going down because the markets are changing. People do less shopping at the mall now, and they do more of it online. You also have things like wars, disaster, terrorist attacks, things that completely throw the economy into disruption will also affect the value of stocks. At all times, you have some companies that are booming. Amazon, Apple, Tesla right now are booming. And on the other hand, you have some companies that are dying. Sears, bankrupt. Forever 21, bankrupt. Payless, bankrupt and gone. JCPenney, bankrupt in the process of being gone. Whoops. However, on average, over the long term, stocks give you a higher return. What I'm talking about here is the need for diversification. Over the long term, you want to be in stocks because stocks, they go up and down, but over the long term, they go up the most. However, you have to be diversified because you're not smart enough, I'm not smart enough. There are damn few people in the world that I would say are smart enough to know which companies are going to thrive and which ones are going to hit a bump. You don't know when management's going to make a good decision and a bad decision. So you have to be diversified. Okay, so stocks are riskier. They are more volatile. This is a chart of what stocks have done from 73 to 2016. This is 1 year returns. So what this is saying is between this time period, so what do we have there? 43 years, the best single year that stocks had was a gain of 60%. Holy cow. The worst year that they've had was minus 42%. Ouch. Imagine you have $100,000 in your 401k. You're feeling good. And that 100,000 becomes 58,000. That's what we're talking about. 100,000 to 58,000 in 1 year. You'd be sick. Now, if you look at a 3-year time period, well, the best year is, what is that? 35%, 30%, and the worst year is minus, say, 18. You get to a 5-year period, 20, 30, that's about 30% best year, worst year, minus, say, 5%. So you get the point is that over time, stocks make more money. If you look at any 15-year period, stocks went up. Now, there are some 15-year periods where the average stock return in this case was only like 5%, which isn't real exciting. But any 15-year period, stocks went up, and the best 15-year period, they average about a 20% return. If you look at any 20-year period, the worst 20-year period you can find would be a return of, what are we going to say, about 7, 8%, and the best is 19%. So what this shows you is that over the long term, the bumps in the return of stocks don't matter. Over the long term, you will make money in stocks. Over the short term, no, not necessarily. So if you're putting your money away for 5 years, you might not want to invest in stocks. You have a chance of a higher return, but you also have a chance of losing money over a 5-year period. But if you're investing for 20 years, and if we continued this chart on for 30 years, 40 years, the same trend would happen. Over the long term, you will make money with stocks. Some stretches are going to be better than others, but you're going to make money. Here's another chart that shows the same phenomenon, but it's over a longer time period. Hold on. I need to switch screens here. Okay, sorry about that interruption. So this article is from 1872 to 2018, over 100 years of history. And this shows what stocks have done during that time period. The green is when it's made money, and the red is when it's lost money. So those are 1-year periods. There's been a lot of years where they've lost money. 5-year periods, yeah, there's still periods where 5-year periods where the market lost money. 10-year periods, most of the time you make money over 10 years. There are some losers. And over 20 years, there are no periods where you lost money. The maximum for a 20-year period was a 13.2% return, and it just went away. Let's take a look at those numbers again. Over a 1-year period, the best year was 53%. The worst year was minus 37, average of 8%. Over 5-year periods, maximum was 28.5. The worst year was minus 12, worst 5-year period, average 7%. Over a 10-year period, the best was 17.6. The worst was 4.1%. 10 years, you lost 4%, but the average was about 7. Over a 20-year period, the best was 13.2. The worst was 0.5%. That ain't much. And the average was 6.7%. So again, the key is stocks are volatile. Over short periods of time, you can lose money. You can lose a substantial amount of money. Over a long term, you're not going to lose money. And sometimes your returns may not be good, but they're still going to be better than the other investment options that you have. Okay. Now, what if bonds are safer? They don't vary in price as much as stocks. What if we took some of our money and put it in bonds, which are slower and safer, and we took some of our money and put it in stocks? So this chart shows what a portfolio of mixed bonds and stocks would look like. This is looking from 1926 to 2013, so about 80 years. What this shows on this end, if you put all of your money in bonds, the best year you would have had would be 33%. The worst year would be -8%. The average is 5.5% over this 80, 90-year period. Let's go to the other end. If you put all of your money in stocks during this period, and this is consistent with what we've just looked at, the best year would be -54%, the worst would be 41%. The average return over that time period is 10%. In between, they have different portfolios where, let's pick one here. If you were at 40% bonds and 60% stocks, max 37, minimum -27, average 8.8. So what this shows is that as you add bonds to your portfolio, you are reducing the risk. You are reducing the chances of losing money and the magnitude of the highs and lows. And you're also reducing the average return that you're going to get over time. So how do you apply this information? Here's a standard rule. You should take 110 minus your age, and that's how much of your retirement savings you should put in stocks. And the rest you should put in bonds to reduce that risk. So what it says, if you are 25 years old, you should have most of your money, 85% of your money in stocks, because that's where you get the maximum return and you are investing for the long term. So those ups and downs don't matter, but we're going to throw a little money in bonds to provide some stability. As you get older, then you should be shifting your money out of stocks because your investment time frame, the number of years that you're investing your money for before you want to spend it, has gotten lower. So you can't afford the ups and downs of the stock market to the same extent as a 25-year-old. So as you get older and you want to start spending that money, and you're going to be spending that money over the next decades, you need to get more conservative, and you're reducing the amount of your money that you have in stocks and increasing the amount of money you have in bonds. Does that make sense? As your investment time frame becomes shorter, you need to trade in some of the high returns in exchange for more stability of your return. Now, a fairly new mechanism, I'm changing gears here. There are lots of target date funds now. So when you get your 401k form, or if you look at your IRA investment options, you're going to see target date funds, which are like target date 2065 or target date 2070. What that says is, what is your target date for retirement? And if you put your money in these target date funds, they're going to say, okay, if you're going to retire at that point, well, then you must be about 25 years old. So they're going to put up a portfolio mix, something like this. And then as you get closer to retirement, you leave your money in this fund. Every year, they're going to adjust it and continually reduce the risk, reduce the percentage of stocks as you move towards retirement, just like this formula here. So if you don't know much about investing and you want to just put your investments on autopilot, these are a good option. I don't love them because they tend to be even more conservative than this. They tend to put even more of your money in bonds and less in stocks than I'd like to see. So you're probably reducing your total return more by using these. But then again, you're putting your investments on autopilot and you don't have to worry about it. Okay, just a couple more lessons. This is a chart. Wow, it looks busy, doesn't it? Hang on. The blue line shows how much money people were putting in and out of mutual funds. So if you're below zero, if the line's below zero, it means that people in net were pulling money out of mutual funds. When it's up here, they were putting lots of money into mutual funds. The black line shows what the stock market was doing during that same time period. So if you look at this, you see a fair amount of correlation. That when the stock market is high, people are putting lots of money in mutual funds. And when the stock market is low, like here or here, people are pulling money out of mutual funds. So what you have happening here, on average, the average investor, they are buying more stocks when stocks are high. And they are selling stocks, taking money out of mutual funds when stocks are low. Does that sound like a good approach? That you want to buy an investment when it's priced high and you want to sell an investment when it's priced low? Hell no, that is exactly wrong. Why does this happen? Why are people so stupid? Because what happens is when the stock market is booming, like it is currently, then everybody hears in the news that, oh, the stock market's booming, and they're talking at the office over the water cooler that, oh, my IRA went up this much last month and my 401k went up and stocks are just kicking butt. And so then everybody feels like, dang, I'm missing the boat. I need to get into stocks. I need to put more money in stocks because they're kicking butt. And they end up buying when stocks are high. And then when stocks go down, they go, oh, crap, I just lost money on my stocks. Stocks are just a Vegas casino. They're bullshit. I can't handle the risk of stocks. I need to get out. So I'm going to pull money out of my stock mutual funds and put it into something boring. And by doing that, they are doing exactly wrong. They are timing the market perfectly wrong. Here's what you want to do to be smarter than the average bear, and it's boring. It's called dollar cost averaging, which means you're going to invest the same amount every month. You're going to set up your paycheck so that $500 is going into your mutual fund every month. Or you're going to set up an IRA and they're going to pull money out of your checking account every month automatically so that there's $400 going into your IRA, into a stock mutual fund every month. And what happens when you do that? Then you're buying stock at the average price. Sometimes you're buying stocks when stocks are really high. On the other hand, you will also be buying stocks when stocks are really low. So over the long term, you're going to buy stocks at an average price, which is way better than what the average stupid person is doing. Because the average person is buying them when they're high, selling them when they're low, and shooting themselves in the foot. If you simply get yourself on an investment schedule where you can do the same thing all the time, you can be less concerned about the highs and lows. Now, I always get people in general, young people are worse, who want to time the market. It's like, oh, I think I can predict when the market's too high, and I think I can predict when the market's too low. And I can show you mounds of evidence that will show you that no, you are not smart enough. In fact, mutual funds, there are mutual funds where they have lots of Harvard MBAs, and all they do is watch stocks and try to pick when to buy which stocks and when the market's high and when the market's low. And statistically, those Harvard MBAs are wrong 85% of the time. The 15% of they're right, the 15% of the time they're right, I'm going to tell you, that was just blind ass luck. Because if you throw enough darts, you're going to hit the bullseye once in a while, right? So even those people who do nothing but study and watch the stock market aren't smart enough to predict when the market's going to go up. So do not try to time the market. With one exception, here's my rule. You always buy stocks. If you feel really strongly that the market is low, buy more stocks. That's it. Never try to sell when it's high and try to buy when it's the lowest. Always buy stocks. So you always have that $500 a month going into your retirement plan. If you're convinced that the market is really low and you can scrape up another $300 or another $500 and you want to buy more stocks, okay. Because over the long term, putting your money in stocks is going to be a good deal anyway. If you're right that it's low, it's even a better deal. Other than that, don't time the market. Always buy stocks. If you're convinced it's low, buy more stocks. That's all the market timing you'll try to do. That's called dollar cost averaging. Okay, I've covered a lot of ground here. There's a lot of information. I will take a look at the textbook to see if there's any summarizations in the textbook that'll be helpful. If so, I'll let you know. I'll post those. I think I've covered things pretty thoroughly, but if I've really left something, questions in your mind where you don't get how this works, or you've heard this and you want to check it out, please send me a question right away, and I will answer it either as part of the class, or I'll just send you an individual answer depending on how specific it is. So this is a big, important topic. Please give me feedback. Let me know if you have any questions. If not, we're moving on. Thank you.